and welcome to Mould on Markets with Investment Director Russ Mould. Russ, how are you?
Very well, Clara. How are you?
Not too bad
Good.
at all. With things as they are presently, what is it that advisors and their clients should be thinking about right now?
Things as they are is quite a polite way of putting it because the markets are currently in a bit of a funk. There's been a big loss of risk appetite, and that's easily seen in the fact that share prices and commodity prices are going down, bond prices are going up, i.e. bond yields are still creeping lower.
What is it that's caused this sudden loss of nerve in what were previously bouncy markets?
Yeah, and there's no one single thing you can put your finger on. I mean, the IMF's forecasting record is no better or worse than any other economist, so make of that what you will. But they have just cut their global growth forecast for the 9th time in 12 quarters and also warned of a 4 in 10 chance of a Eurozone recession next year. So their world economic outlook certainly hasn't cheered anybody up. On top of that, I think more fundamentally, you've still got confusion over China, you've still got those awful German economic numbers that have come out in the last couple of weeks, and you've got the Federal Reserve removing the market safety net when it cuts QE to zero on the 29th of October.
So are these signs that clients and advisors should now be following?
Definitely. I mean, it certainly prompted some head scratching amongst the analyst community. Bank of America Merrill Lynch has just published a report called 4 Canaries in the Coal Mine Just Died. Now, it's not the cheeriest of title, but it does show that people are starting to probe around and try and feel out for what trends they should be looking for to try and quantify risk on, risk off.
So what's the 4 trends they've identified?
Yeah, good question. So then the 4 charts behind us show us these, and thankfully regular viewers, without wanting to sound like a cracked record, they'll be familiar with a few of these, and my blog on SIP Centre will also cover them in greater detail. But the first one is commodity prices. Now this is the Bloomberg Commodities Index. It follows the futures price of 22 raw materials. Pretty clear trend, right? Straight down. The second chart is emerging market equities. This is the MSCI Emerging Market Index in dollars. And again, same picture, straight down. Third chart, junk debt, speculative grade corporate debt. These are 2 exchange-traded funds listed in New York that follow this particular asset class. And again, straight down, showing a retreat from riskier asset classes. And finally, small caps. I could do this for any geography, but I've done it, a little bit of geographic bias for the FTSE small cap and the FTSE AM all share. Same trend, straight down. So those are 4 kind of high risk assets, or perceived to be, very clearly have sold off. So if we begin to see a stabilisation in those, or even a pickup, then that may be the market correction dealt with. If not, you get a more fundamental loss of nerve, then you could easily see a 10% pullback in major equity indices, and that would be the first since August 2011. So there'll be a few commentators out there saying, might not be a bad thing, all things being equal, take a little bit of froth out of the market, but keep an eye on those 4 trends.
Okay, thank you, Russ. That's it from us. We'll see you next time. Goodbye.